Now, I did have a quick question that came in during coaching sessions this week. Actually, it was today, as a matter of fact. My apologies. And it was a customer asking about a clarification on diagonal calendar call spreads, poor man's covered calls, and a filter that we have that we use for our default searches on the calendar call screen. So what am I doing in a calendar call? Poor man's covered call. Well, I'm buying a call in the money, typically, that's farther out in time, maybe 200 days, maybe 300 days, maybe a year out in time, 406 days here for June. And we're using it sort of as a stock surrogate. Instead of buying the stock and doing a covered call, we're buying an in-the-money call at a fraction of the price, maybe with a relatively high delta, maybe 0.7, 0.75, 0.8, maybe closer to 1, depending on what your structure is. And we're going to sell near-term calls against the position. Now, let me see if I have a good one here. Let me make some adjustments to this real quick. I want to go ahead and make sure that I'm not going more than 3 or 4% out of the money on the sold call. And I want to go maybe only 20 to 14 days out in time. Let's go 21 days out in time, not 22. Let's go about 3 weeks out in time. Keep it shorter term. Keep the long call further out. All right, so let's bump that back up to 5. Okay, so I don't want to go more than 5% of the money. It should be pretty good. There we go. Okay. So not a direct recommendation, but we've got a few positions here. HPQ is at 29.72. I can sell the 31st of May, 21 days out, 31 call, and buying an in-the-money January 27 call. Now, the delta there is only 0.69, but that's okay. We're just going to leave this as is for the example. Here was the question, though. There's a filter that we use. Important things that you might want to consider for the calendar call spread, a time spread. You've got the time value ratio, where it's the long option time value divided by the short option. All right, so you want a relative time value ratio. The implied volatility ratio. Preferably, I'd look for an implied volatility ratio. There's implied volatility of the sold option divided by the bought option. I want to see a higher near-term implied volatility. I want to see implied volatility ratio of greater than maybe 1.1 or 1.2, meaning the short option implied volatility is 10% or 20% higher than the long option. And down here for me, one of the important things, in addition to the delta ratio, I feel that's important as well, but it's this debit to strike difference ratio. And that's what the customer had a question about. What exactly is this and what does it mean? Well, as you can see, whenever you hover over a filter on the PowerOptions search tool, you get a little pop-up definition of what this criteria is. The debit to strike difference ratio is the net debit that you're paying for this initial step of the calendar call spread. What I'm paying for the long minus what I'm collecting from the short. That gives me the total net debit. But this is divided by the difference in the strike prices on the spread. And typically as a default, in our default searches for these kind of strategies, I want this debit to strike difference ratio to be less than 1. I want the net debit that I'm paying for this initial step. Yes, I'm going to continue to maybe roll this call several times or a few times at least to hit my target goals. But I want this to start out with this less than 1, meaning in this case, at midpoint prices for our HPQ position, we're paying $4.45 for that January 27 strike, and I'm collecting 50 cents for the 31. Now this at midpoint, my net debit would be $3.83. That's at the midpoint price. This is showing the natural bid and the natural ask, but at best price at midpoint, my net debit would be $3.83. My difference in strike prices, 31 to the January 27, is 4 points. This naturally meets that criteria. My debit of $3.83 at best midpoint potential is less than the 4 points difference in strike prices. Why is that important? Why do I harp on this and why do I continue to talk about this and why does it come up? Well, the concept is, what is a calendar call spread or quote unquote poor man's covered call? Instead of buying a stock and selling a call against it, where if the stock is anywhere above the short call strike price at expiration, I make the max return of 2 to 3%, for example. In that case, calendar spread, you get this time structure where the max return that we're expecting, here potentially at 35.9%, occurs right at the short option strike price. And the reason why is because we're taking account, just as your broker would calculate it the same way, they're probably calculating it the same way. The peak here is when the option is still at a zero value. Your short option is at a zero value. It's going to expire worthless, or it's right at the price. And you've got the maximum value of the long option because of the positive delta ratio. Now, with the calendar spread, what happens? Let's put this towards expiration. Let's say if the stock was trading right at 31, our short call strike price on expiration day, which was May 31st, okay? All right, so now what we see in this structure is the peak profit here on 531 is based on the theoretical price of the long option. Why does this tail off? Why does the profit tail off here? After we go above $31, we're in a covered call. It would always be the same, whether the stock was at $35, $38, $40 per share, we'd still get assigned to make that 2 or 3% return. And this is because at expiration or close to expiration, that delta ratio we wanted, there was a positive 2 or 2.0 to start with the default screens, now reverses. Why does the delta ratio reverse? Because at expiration, your sold option is going to a delta of 1 or 0 very quickly. If it's in the money, it's going to a delta of 1. If it's out of the money, it's going to a delta of 0. So what ends up happening is my long option, though deeper in the money, it's not at a delta of 1. The stock went up to 31. It's probably now moved from a delta of 0.69 to 0.75, 0.85, maybe even 0.9, but it's not 1. So now for each dollar the stock moves up, I'm losing more technically on the sold option that I might have to buy back, nearing a delta of 1, than I'm gaining on the long option, because it's still hovering at 0.92, 0.93, 0.94, somewhere in that range. It's not 1-to-1. So that's why this starts to trail off once you go above that price. In this example, what do we not see really? It comes here later in the end, but what we don't really see, even if the stock's trading up at 40, 41, or 42, we don't see the position go into a negative or a loss value at the higher prices. It can't. Even in the worst case scenario, what is the worst case scenario? I'm in this HPQ calendar spread. Some good news comes out. I doubt anyone would buy HPQ. It's too big. But some positive news comes out. The stock suddenly jumps up to $36 per share. Let's scroll down here. What did we do? We said, what if the expected price at $31, our short option strike price on expiration date, what would we expect? Well, the call value would go to 0. It would expire. But the long call that we bought for January would expect to increase up to $5.76. We keep the full 55-cent premium on the short call, right at $31, and we have an increase of $138, $139 on the long, so that's the profit of $193.50 if we're able to sell to close the long call. Now, if the stock gaps up, goes to 38 suddenly overnight, long people who bought the call for this May 31st expiration at this 31 strike start selling to close the calls. Market maker has them balanced. He starts assigning early the sold calls at the 31 strike. Your broker sees that. He says, you don't own the stock to cover the obligation of the sold call. So what I'm going to do is exercise your January call. We're going to buy shares of stock for you at 27 and sell them at 31 to cover your obligation of this assignment. In this case, you don't get $576 back. You get the difference in strike prices, which is 4. The difference between 27, where they were forced to buy shares of stock for you by exercising your long to cover the obligation of the sold call at 31. So although the stock met your expectations and went up, you don't see the max profit. If you went through exercise and assignment, let's say the price here, the debit at best was $3.83, you get $4 back. you only made $17 or 17 cents per contract on the position, not the 137.37, which only occurs at the max peak profit. Side note, this is why I don't like using the term poor man's covered call, because investors who learn the covered call say, hey, yeah, this is great. I bought a stock. I'm quote unquote renting it out. But if I get assigned and the stock's anywhere above that, I make this guaranteed 2 to 3%. But I want to use less money. I want to use leverage. So I'm going to look into this poor man's covered call, this calendar spread. But that return, you see, hey, it's leveraged. It's tenfold what I could make on the covered call position because I only paid $437.50, not $29.72. So I'm using leverage in my favor, but it only occurs here. And that's assuming that the implied volatility on the long option remains the same in the theoretical pricing models. If there's a drop in implied volatility, you might get less than that. Even by some miracle, HPQ is trading at $31 exactly on May 31st. All right. Where does this come important? Well, we just illustrated it in a sense. That's why I don't like to use the poor man's covered call, because it leaves out the fact that you only get this return at that point. You have to know that the return is going to be less. And if your structure is wrong, if you pay too much for the long call, where the net debit that you pay into the position is now higher than the difference in strike prices, in that scenario I just described, even though the stock, this is a bullish strategy, neutral to bullish strategy, but even though the stock went up as you expected, instead of seeing a profit of 35.9% or $137, if you go through the exercise and assignment, instead of seeing a profit you expected of the difference in the strike prices minus the net debit, if the net debit is higher than what you paid, let's put it up at $535 instead of $435, for example. Now my net debit is $480. And if the stock runs or has a large gap, and I go through that exercise and assignment on the expiration date, or I hold it through expiration, the stock's at 34, 35, 36, I am now at a loss. Because if I allowed it to get assigned without rolling it, closing the short call, or trying to continue the trade, debit was 480, difference in strike prices was only 4, I get assigned early, my broker exercises the 27 to deliver the 31, I only get $4 back. So now I'm in the loss zone of 80 cents. That's why that filter for the debit to strike difference ratio of less than 1 is important. Because in these scenarios where there's a sudden breakout, we had a customer several years ago, might have been as much as 7 or 8 years ago, we had a discussion on the open forum where he got wronged completely. His position, he was in a calendar spread, the stock was slightly above the short call strike price, didn't quite pay attention to the ex-dividend date, didn't set it as an alert in the PowerOptions portfolio. Crossed the ex-dividend date slightly in the money, got assigned. And because it was the ex-dividend date, well, let me take a step back. What his broker didn't do, which I had never heard of before, and I want to say, I hate to say this, but I want to say it was Merrill, I can't remember, they did not exercise the long to deliver the short. In that case, he would have had a small profit had that happened. But what happened to him was he got assigned early on the short call. His broker did not exercise the long to deliver the short. So what does that mean? That means he was now short shares of stock, in this case at $31, with the stock trading at 32. He was on record of being short shares of stock. This was probably about 30 to 40 contracts, if I'm not mistaken. So 3,000, 4,000 shares that he was now short on ex-dividend date. So he had to pay the margin requirement for being short stock. He had to pay the dividend because he was short stock. And then I think he got a penalty because technically in his account, he wasn't supposed to be short shares of stock. It was a trifecta of he got fouled over, lack of a better term. He got it corrected. Okay, he got that corrected a few weeks later, if I remember correctly. But that is another risk in these leverage scenarios, is that if you're not paying attention to things like the ex-dividend date or the earnings date, you could get assigned early depending on where the stock is in relation to the strike price of your short call, And if your net debit was greater than the difference in strike prices, instead of having an expected win, the margin win that you're looking for by using margin by paying for the long call instead of the stock itself, quote unquote, the poor man's covered call, you can end up in a loss zone. So that's a little bit on the clarification of that filter, the debit to strike difference ratio, why we set it to less than 1 in the calendar calls and the calendar puts, and why it's important that it's there. Does not mean, of course, that positions on a stock that you like where it just happens where the net debit is greater than the difference in strike prices means it's a bad trade. You just want to be careful, analyze the profit and loss chart, and make sure that you're ready to manage it if it goes in the money so that you don't get assigned early. Don't risk getting assigned for a loss when the stock did what you expected for a neutral to bullish position. So on that note, going back to our calendar call discussion, Boyce says, what about selling weekly calls upon a poor man's covered call? Sure, you can do it any way you want to. Okay, I mean, investors that I've talked to and positions that I've tried to do, Boyce, with the calendar spread, basically what I've done is, hey, if in general, I prefer following some of the similar rules we use for the married put, the radioactive trading techniques, following the 3 core principles of radioactive trading, the at-the-money bell curve, forcing an ideal size trade, of course, and the radioactive decay line or the time decay curve for options. When I'm in a calendar spread, it is a similar approach to what I'm looking for the married put. What do I mean by that? I mean, it's a longer term trade. I'm planning on staying in it longer. And I'm looking for a stock that I feel has a good chance of moving up, say, 5 to 8% in the next, really 3 to 6% in the next 20 to 40 days. But in the 60 to 80 days following that first 20 to 40 days, I have an expectation it could go up as much as 8%, 10%, or more. But it's a stock I can't afford to do as a married put in my portfolio, so I'm going to do it as a calendar call spread or a diagonal poor man's covered call. Now, I'm going to be selling, me personally, with that structure that I use. I'm probably selling 14 to 21 days at a time, as we illustrated with the search earlier. I'll probably lump this discussion in with the previous discussion we had as sort of a follow-up with an intermission in between, in any case, boys. But yeah, just for me preferably, although the defaults I know is showing 42 days, we made that change and we put it out to about 25 days and limited it to about 5% out of the money, if I'm not mistaken, maybe 6%, 7% out of the money. And we only had those 3 results. So I might open that up a little bit more. But in any case, there's nothing wrong with doing this structure with weekly options if they can meet your criteria. And in other words, let me just do this. Let's go 9 days out in time. Short term. And no results are going to match my criteria. I'm going to take this out of the money filter out there, boys. Let's see what we've got. Okay, there's one that comes up, new holdings, weekly against 252. Why am I only seeing one result here? It's most likely because the option premium that we're getting for the weekly series with this setting, the time frame of 250 to 650 days out in time, those positions aren't matching the debit to strike difference ratio of less than 1. I'm not collecting enough premium on the weekly to keep within that strike difference, so it's only giving me one result, even though we know we had multiple stocks that matched this other criteria set that we wanted to have. Okay? So when I say the weeklies, what did I do initially? Okay, I got 21 days out in time and I was 250 days out. An important criteria that we like to have here that I don't have here. I apologize for that. No, it is here. It's in the more section. No, it's not. I apologize. We have it as a filter too, if I'm not mistaken. But it's the, no, we don't. Oh, I'm sorry. I know where it is. My apologies. Let me go back. The right cycles. There it is. I'm sorry. It is there. The right cycles. So when I was 21, 22 days out in time, boys, okay? And I was out 250 to 300 days, I had essentially 10 right cycles, meaning that if I sold the call every 21 or 22 days against a 250 day out option, I could sell it 10 times. Okay, so those right cycles is something that you might tend to look for depending on the structure you're using. But in this scenario, when I'm going shorter term, I'm not seeing a lot of results because of that smaller premium is not putting me to the debit strike difference ratio I prefer. So I've got to shorten this. let's go. I still want 10 right cycles and I'm 7 days out in time. So minimum, I probably want to be 80 days to let's push it out to 250. Okay, sort of switching the long structure, the long requirement of the option to still try to get at least 10 right cycles or maybe more. Is that going to open it up more for what I want? Absolutely. Okay, so we got some good ones in here. 160 days, that's great. Here's 224, just shy of the 250 additional filter. So there is nothing wrong with this approach. There's nothing wrong with using weeklies. Hey, we like to use weeklies. I like to use 2 week out in time, preferably for these positions. Just like I like to use for my bold put credit spreads, not 5 to 7 days out, but 14 days out, 11 days out is technically what it is when I open on Monday for the following 2 Fridays. But you've got to adjust the criteria to meet it because, again, the other criteria that we're preferring, the debit to strike difference ratio, maybe even the delta ratio, we have to adjust both. Okay, but we've got some good trades in here. And again, I still might do that same restriction we showed before, Boyce, limiting it to 5% out of the money or less. And we still got some good, Sony, JD, maybe I want to go up to 7%, but I want to keep it close to at the money in a sense when I'm doing this with the shorter term because, 23 cents, okay, 30 cents against 210, that's pretty good. But, 23 cents against 245, 10 times, I'm only collecting 1/10. Maybe I want that to be a little bit higher. That's the trade-off. Okay, that's a trade-off, Boyce, that we see with that kind of structure. Okay, so you want to adjust both. Nothing wrong with doing it. And again, if I'm not mistaken, same strikes. No, I don't have one here. Maybe it is in the sample searches. I thought I put one up. I apologize. Safety first, safety horizontal, 5-star day. Okay, that's something for my to-do list. I do have a default criteria I use for the weekly series. Boyce, using weeklies against longer terms, it's very similar to the initial values. It's just changing the time frame on the long as well as changing the time frame of the short.